Hello viewers, today's topic is investor awareness and the Indian population. So we are going to look first of all how India is poised for growth ahead. India has been a planned economy right from the time of independence. At that time, it was realized that the economy of the country needed participation in those sectors that needed to be developed. So the government would step in at places where there was huge investment to be made, as these could be done only with the help of the government funds. Apart from this, the government also stepped in those sectors which were almost non-existent, thus targeting a balanced growth for the nation. Throughout this period, the economy of the country grew at a moderate rate. In the year 1991, the government of India shifted the policy of liberalization, privatization and globalization, wherein the various sectors of the economy were thrown open to foreign investments, the licenses were done away with, and many other reforms were introduced. This was roughly the beginning of the large foreign money being invested in the country for years to come. These policy reforms, like any other phenomenon, brought with themselves some pros and some cons. On the contra side, it made us vulnerable to the investor sentiment abroad, thus making the stability of our country's growth volatile. Also, the dependency on foreign funds by any country is abhorred. Now we cast a glance at the Indian economy. India is one of the fastest growing economies in the world and has emerged as a key destination for foreign investors in recent years. Economic reforms initiated in 1991 yielded many dividends. One of them is the steady improvement in India's relative position in the global economy, reflected in New Delhi's growing influence in the international institutions such as the G8, the G20, and negotiating free trade areas with ASEAN, European Union. Another is the improved efficiency in the economy and the adoption of international best practices in the production of a range of goods and services. A third outcome is India ranking amongst the top 10 investment destinations since 2007 and 8, attracting $195 billion in FDI, that is foreign direct investment, and $97 billion in FII, that is foreign institutional investments, over the past 5 years. India's GDP has also grown at around 7.9% between 2003 and 2012. This trend, according to the International Monetary Fund, is likely to continue for the next 5 years, with an average GDP growth rate of 7.7% per annum till 2017. India's GDP for 2013, valued at $1.9 trillion, at current prices is the 10th largest in the world. The government has set a target of 8% during the current 5-year plan, that is 2012 to 2017, based on the demonstrated ability to sustain national economic growth despite the global financial crisis, Eurozone woes, and the resultant slack external demand in recent years. India has a favorable demography for high growth. India not only supports one of the largest populations in the world, but also one of the youngest. 50% of its population is below the age of 25 and 2/3 below the age of 35. Also, about 65% of Indians are in the working age group of 15 to 64 years, giving the country a significant edge in terms of cost competitiveness and low labor costs. Moreover, India's labor force has a strong knowledge base with a significant English-speaking population, making it a top destination for multinational corporations that are looking to expand their overseas operations for the market and talent. Apart from this, the Indian consumer market will grow 2.5 times by 2025. Consumer spending in India grew from $549 billion to $1.06 trillion between 2006 and 2011, putting India on the path to becoming one of the world's largest consumer markets by 2025. India's consumption is expected to rise 7.3% annually over the next 20 years. By 2040, 9 out of every 10 Indians will belong to the global middle class group, with daily expenditures ranging between $10 and $100 per person in today's purchasing power parity terms. 70% of this expenditure will be on discretionary items like entertainment, healthcare, communication, education, personal products, services, and so on. The absolute number of Indian middle class will touch 1 billion by 2039. This rise of India's new middle class is globally significant as it will usher fundamental changes in India and around the world by triggering waves of innovation in production and distribution and delivery of goods and services, including government services. Innovations like the $2200 nano car by Tata Motors, the inexpensive handheld electrocardiogram, that is ECG machine from General Electric Healthcare, and a low-cost water purifier called Tata Swachh by Tata Chemicals, a battery-powered Chotu-Cool refrigerator by Godrej, and a mobile phone application called Nokia Life Tools by Nokia for rural consumers to access agricultural, educational and entertainment content are some examples of frugal engineering that are primarily aimed at the Indian market, but will likely find buyers in many other parts of the world as well. Such ideas deserve investment. Indian investors are not as participative in the stock markets as they can. The advantage that lies in the population en masse investing in the country could put our country in a win-win situation. Both the country as well as the people would benefit as a result, thus sharing the benefits of progress. Indian economy being one of the fastest growing economies in the world eyes India as an investment destination. So we explore the option of how the Indian population can benefit from the same. Ironically, it has been observed that Indian population is shy of investments directly, though they have an indirect presence through the channels of life insurance, mutual funds, etc. The capital markets in India have a very little participation by individuals of the country. It is indeed an irony that on the one hand, the country is groping with the problem of unemployment, and on the other, the youth are totally ignorant as well as hesitant towards the investment options that are available through various investment that are offered by the country in the form of capital markets, real estate and others. The capital markets carry the investments of foreign institutional investors, domestic institutions such as life insurance companies and the investment banks, etc. presently. But the Indian individuals possess only 2 to 3% investments in the Indian capital markets. And now friends, we'll cast a glance at the foreign direct investment in India. Trends in India's foreign direct investment are an endorsement of its status as a preferred investment destination amongst global investors. India's strengths span telecommunication, information technology, auto components, chemicals, apparels, pharmaceuticals and jewelry. India's steady economic liberalization and its embrace of the global economy have been key factors in attracting FDI. The government recently opened a multi-brand retail and civil aviation markets to 51% and 49% FDI respectively, and with more reforms expected in insurance and pension sectors, amongst others, India will continue to offer compelling opportunities to the global investment community. Thus, the Indian markets on the whole are considered to be highly leveraged markets. Since they are leveraged, they have the characteristic of volatility too. The India VIX, which is the volatility index of the Indian capital markets, is indicative of the extent to which Indian markets are vulnerable to environment. Such immense fluctuations do not augur good for the investor sentiment, as the Indians are already risk-averse and often seek stability in the investments. This vulnerability is due to the change in investor sentiment in response to environmental factors. Now friends, we are going to see what the lessons of the Asian economic crisis of 1997 taught us. The bane of dependency on foreign investments was amply demonstrated by the Asian economic crisis. Until 1999, Asia attracted almost half of the total inflow into developing countries. The economies of Southeast Asia in particular maintained high interest rates, attractive to foreign investors looking for a high rate of return. As a result, the region's economies received a large inflow of money and experienced a dramatic run-up in asset prices. At the same time, the regional economies of Thailand, Malaysia, Indonesia, Singapore and South Korea experienced high growth rates, 8 to 12% GDP in the late 1980s and the early 1993. This achievement was widely acclaimed by financial institutions including the International Monetary Fund and the World Bank, and was known as a part of the Asian economic miracle. But the miracle did not survive too long for the reason that these economies were hit by a severe crisis in the year 1997. The big lesson to be taken from them was the dependence on foreign capital was a double-edged weapon, which could do as much harm as it could do good to an economy. Thus, the Asian financial crisis was a period of financial crisis that gripped much of the East Asia beginning in July 1997 and raised fears of a worldwide economic meltdown due to financial contagion. The crisis started in Thailand with the financial collapse of the Thai baht, after the Thai government was forced to float the baht due to lack of foreign currency to support its currency peg to the US dollar. At the time, Thailand had acquired a burden of foreign debt that made the country effectively bankrupt even before the collapse of its currency. As the crisis spread, most of Southeast Asia and Japan saw slumping currencies, devalued stock markets and other asset prices, and a precipitous rise in private debt. Indonesia, South Korea and Thailand were the countries most affected by the crisis. Hong Kong, Laos, Malaysia, the Philippines were also hurt by the slump. Brunei, China, Singapore, less affected, although all suffered from a loss of demand and confidence throughout the region. Foreign debt to GDP ratios rose from 100% to 167% at the four large economies of Association of Southeast Asian Nations, that is ASEAN, economies in 93 to 96. Then shot up beyond 180% during the worst of the crisis. In South Korea, the ratios rose from 13% to 21% and then as high as 40%, while the other newly industrialized countries fared much better. Only in Thailand and South Korea did debt service to exports ratio rise. Although most of the governments in Asia had seemingly sound financial policies, the International Monetary Fund stepped in to initiate a $40 billion program to stabilize the currencies of South Korea, Thailand and Indonesia, economies particularly hit by the crisis. The effort to stem a global economic crisis did little to stabilize the domestic situation in Indonesia. However, the government in 1998 was destabilized in the wake of widespread rioting that followed sharp price increases caused by a drastic devaluation of the rupiah. The effect of the crisis lingered throughout 1998. In 1998, the Philippines' growth dropped to virtually zero. Only Singapore and Taiwan proved relatively insulated from the shock, but both suffered serious hits in passing, the former more so due to its size and geographical location between Malaysia and Indonesia. By 1999, however, analysts saw signs that the economies of Asia were beginning to recover. After the 1997 Asian financial crisis, economies in the region are working towards financial stability on financial supervision. The lessons learned from the above failure is that capital markets essentially should not be driven by foreign funds, because then their dependence factor reduces considerably, apart from the fact that benefits of industrial progress can be shared by the people of the country rather than them going out of the country. A reason for the above crisis was part fundamental facts and part due to psychological contagion of panic selling. In finance, it is called herd instinct or herding. Herd instinct is a mentality characterized by a lack of individual decision-making or thoughtfulness, causing people to think and act in the same way as the majority of those around them. In finance, a herd instinct relates to instances in which individuals gravitate to the same or similar investments based almost solely on the fact that many others are investing in those stocks. The fear of regret of missing out on a good investment is often a driving force behind herd instinct. Also known as herding, such investor behavior can often cause large, unsubstantiated rallies or sell-offs based on seemingly little fundamental evidence to justify either. Herd instinct is the primary cause of bubbles in finance. For example, many look at the dot-com bubble of the late 1990s and the early 2000s as a prime example of the ramifications of herd instinct in the development and subsequent pop of that industry's bubble. Humans naturally want to belong to community, a group of people with shared culture and socio-economic reforms. At the same time, people still prize their individuality and sense of responsibility for their own welfare. However, investors can sometimes be induced to follow the herd, whether it is buying at the top of the market rally or going over the cliff in a market crash. Financial behaviorists attribute this to natural human tendency to fear being left alone or the fear of missing out. It could also come down to the raw, powerful emotion of fear, greed and envy that drive people to irrational states of mind. Now, herding can trigger an investment bubble. An investment bubble results from a rapid escalation in price of an asset over its intrinsic value, which is caused by exuberant market behavior perpetuated through a positive feedback loop. The bubble inflates until the asset price reaches a level beyond economic rationality, when further increases in price are contingent purely on investor continuing to buy in that high price. When no more investors can be found to buy at that price level, the bubble begins to collapse. In highly speculative markets, the collapse can occur quickly with far-reaching corollary effects. Now viewers, let us cast a glance at the benefits of investing in the home country by the population. On an individual level, the people of the country remain devoid of immense earning potential that is listed organizations of the country provide. It is really an irony that the people, institutes across the world invest and reap the benefits of growth, but for the average Indian investor keeps himself aloof. If people of India park their investments in the country, then the industry of the country would receive the much needed capital to grow. More employment could generate cyclical effect of higher per capita income leading to higher domestic demand. This buffers any country from the dependency of foreign markets for the sale of their goods. In this manner, the country is protected against the negative effects of recession in the countries that are its export markets. Amongst other advantages that the individual investors have is the advantage of passive income, that is income that the assets earn for them, such as dividend earning stocks and the mutual funds, bonus shares, etc. Also, if the savings rate of the country is enhanced, the savings can be reinvested, thereby triggering off a cyclical effect of profit from the investment getting reinvested. Small investments result in big aggregations when the whole population is involved. This leads to an equal decrease in dependency on foreign funds. Thinking for the reasons for lack of investments, upon inquiry into the reasons for the lack of exposure to the various instruments that are available for investment domestically, a few characteristics of the Indian population get highlighted, and these are: number one, a risk-averse attitude towards financial assets. The traditional Indian mentality is never to put money into a state of risk. Probably, it is part due to the money still not being very abundant here, India being a developing country still, and part due to the risk-averse nature of the average Indian. A research conducted by the Indian Institute of Management, Ahmedabad, needs a special mention here. Under this study, the Indian brain was studied for its leadership skills, and it was found that the Indian brain is hardwired to follow. And one of the reasons quoted by the study was the fact that the country was ruled by foreigners for many generations. To conclude, Indians were good followers and not good leaders. Thus, Indians are not in the habit of forging ahead in the area of risk, which is prerequisite of investing and an essential trait of leaders. Point number 2 is the bias towards the purchase of gold. India is the largest importer of gold in the world. India is one of those economies that have a current account deficit problem for long, and the purchase of gold is one of the major reasons for the creation of this. Indian mentality is the one that considers gold purchases auspicious. It is an essential part of every daughter's wedding. It is said, if the gold that lies in the vaults of our country is invested in the industry, the growth rate of the country can be significantly enhanced. India is the largest importer of gold in the world, and there have been times when there was put a ban on import, as that was leading to excessive demand for the same domestically, which further escalated the prices. Point number 3 is poor awareness about the options available for investments. The major problem with the Indian investors is that they are not properly aware of how to manage the risk involved in any type of investment. This leads them not to venture out into investing. There are a lot of options that are available to invest in the capital market that are targeted towards providing the investor with protection against potential losses. These are called hedging instruments. To give an example, options and futures are supposed to mitigate the risk involved in investing into capital markets. On the 4th point, we have that Indians have a wrong notion that investment in the stocks is equivalent to gambling. There is need to be educated regarding the available options to the investor in India and the manner in which the investments are done, so that hesitation regarding investing is gone. This could be undertaken with the help of demonstrations, text materials, lectures, or video content. All these are discussed later on in the lecture. So viewers, you just saw what an investment destination our country is gradually becoming. Also, we saw some lessons that countries around us have taught us regarding investments. Apart from this, we also touched upon the reasons why Indian investors were not investing as much in the Indian capital markets. In the following lectures, we are going to see what are the consequences of poor participation by individual investors, some of the instruments of investment that we have in our country. Apart from this, the various aspects of the capital markets. Thank you viewers for watching this program.